Thank you for joining today's webinar, Bringing Fluidity to Illiquid Assets, using donor-advised funds for flexibility in charitable giving. I am Eric Kanitis, the editor of AEF Insights, a weekly e-newsletter on best practices and thought leadership in the field of donor-advised funds. I'm also the director of content marketing at American Endowment Foundation. AEF was founded in 1993 and today is the leading independent administrator of donor-advised funds in the United States. Unlike most other sponsors of donor-advised funds, AEF is wholly independent. We offer a neutral platform for investment flexibility and grant making. This independence means we are free to focus our knowledge and energies on helping donors achieve their goals. At AEF, we work alongside the donor's trusted financial advisor as our ally. Together, we help the donor succeed with their immediate charitable wishes, as well as help build a charitable legacy that can span generations. A few housekeeping issues today. You can submit questions at any time. However, our answers will be held until the Q&A discussion later in our webinar. Simply use the GoToWebinar module to submit a question. Additionally, you can condense the module for easier viewing. Just click on the little orange arrow, and you'll be able to get yourself a little additional real estate on your screen with which better to see the presentation. I won't read this verbatim, but today's webinar is purely informational in nature and is not intended to serve as formal, legal, accounting, or tax advice. Participants are encouraged to consult with their own professional advisors for advice and insight concerning their specific matters before making any informed decisions. Our agenda today, first off, we'll discuss and define a few terms for common understanding for the entirety of our audience. Terms such as donor-advised funds, S-corp shares, and C-corp shares. We'll also have a brief discussion on the value of charitable planning and asset management. And then finally, we'll get into the specifics of how a deal can be structured involving S-corp shares and C-corp shares. And then we'll move on to our Q&A and our conclusion of our webinar presentation today. The first person I'd like to invite onto our panel is Phil Tobin, Chairman and co-founder of American Endowment Foundation. Since its founding in 1993, Phil has helped AEF to become the largest independent donor-advised fund sponsor in the country with assets of nearly $1 billion. His experience within the field of donor-advised funds is one of the longest in the industry, having implemented the donor-advised fund program in 1986 as CFO of the Cleveland Foundation. Phil pioneered the concept of a national independent donor-advised fund program that allows a donor's trusted financial advisor to manage assets in the donor's fund at all levels on the advisor's familiar investment platform. Phil, thank you for joining us today.
Welcome aboard, everybody, for attending the presentation today. Eric, thank you for arranging it. And Brian, it's always good to work with you again.
Excellent. And Brian, as I mentioned here, is our other panelist. Brian Klontz, President of Charitable Solutions, LLC. Brian is the founder of that organization, specializing in non-cash asset receipts and liquidation, gift annuity reinsurance brokerage, gift annuity risk management consulting, emergency assistance funds, and life insurance appraisals and audits. He is the founder of the Decamai Foundation Incorporated and the Decamai Asset Trust, two national donor-advised funds focusing on illiquid assets generally and S-corp transactions, respectively. Brian, thank you for joining us today.
Thank you, Eric. Glad to be here.
Thank you. Well, I can't imagine a better person to provide a definition and some insights to the field of donor-advised funds than Phil Tobin. So, Phil, I'll turn the podium over to you.
Thanks, Eric. You know, I like to think about donor-advised funds in simple terms. It really is conceived by many people to be a charitable investment account, and that in that it provides donors with a simple, flexible, very often tax-efficient way to manage their charitable giving. Remember, the donor is giving the money to a donor-advised fund as an irrevocable transfer to a public charity. And because it's going to a public charity, there are substantial tax benefits that go with that. The public charity serves as the administrator of the donor-advised fund. Now, since they've been started in the middle 1980s, there are many donor-advised funds out there. You'll find that they're not all alike. Very often they're different with regard to a lot of different categories. Some are more flexible than others in terms of the types of assets that can be contributed and held, who can receive grants and when and how much, how the assets are invested, and then finally, who can take over at the death of the donor and the spouse and move that on into the next generation.
And Phil, obviously there's a lot of tax benefits that accumulate and are available with donor-advised funds, correct?
Yes, there are, but I'd like to go back one, if I could, to the donor-advised funds as it relates, not just in general, but as it relates to American Endowment Foundation, if I could, Eric. Again, they're all different. Many of them are more flexible than others, and I think there's three things I would like to leave to the advisor in this part of it. In that, how are we different as it relates to the financial advisor? In our particular model, the financial advisor manages the investments in the donor-advised funds, and they do it at all levels. And finally, since we are neutral with regard to where the assets are kept, the financial advisor recommends that it be kept on his own personal familiar investment platform. And then, as Eric was just mentioning, there are some tax savings, and Eric, I'll let you move on to the next slide and introduce that, if you would, please.
I've moved on to that, Phil. Yes, indeed.
Good, good. Okay, there are some tax advantages. People do it for personal reasons, but they also do it for tax reasons. And there's some tax issues that really make this an attractive option for the donor as they're considering their taxable, their charitable estate. There are 5 benefits. I tend to think about them as 5. There's an income tax deduction that they get right away. And because the gift is made to a public charity, it's the highest benefit available. And one way to measure that is the amount that they can take as a deduction in any one year. And as you know, there's an adjusted gross income limit on gifts of charitable giving. And with regard to gifts of cash, it's up to 50% of adjusted gross income in any one year. And with regard to all other types of assets, it's 30% adjusted gross income. And of course, you always know that if they can't take it all in the first year, they have 5 more years. So it's the original year plus 5 to take that income tax deduction and spread it out. In terms of avoiding capital gains, generally there is no capital gains. Responsibility of the donor when he contributes those assets, and American Endowment Foundation doesn't pay any capital gains when we were to sell those assets. Since the fund is in our name for the benefit of the donor's donor-advised fund, then obviously it avoids any estate taxes that the donor might have, because the assets are not in his name anymore, they're in our name. In many instances, you might look upon it as very much similar to a Roth account, in that the earnings on the fund while they're there, are basically tax-free. There's not a tax-deferred arrangement like a 401k. In that regard, it's much like a Roth, in that whatever it earns totally tax-free. There never will be taxes on it. And then there's the final category, which is sort of intriguing for a number of people who are faced with what might be called alternative minimum tax. Not everybody is, but to the extent that a donor is exposed by reason of alternative minimum tax, then a contribution to a donor-advised fund as a public charity will reduce that alternative minimum tax. So basically, there are 5 tax benefits, and they're very attractive, which makes them sort of tax smart.
Excellent. And then obviously moving on to a topic you touched upon a bit earlier, beyond the tax matters, the benefits of really the charitable aspects of why people get involved in a donor-advised fund, and that concept of charitable planning.
Yeah, just like financial planning is the concept of putting thoughts and strategy into and how an individual manages their personal financial assets. Charitable planning does the very, very same thing, but it relates to the client's charitable assets. And yet at the same time, we find from our own personal experience that many advisors are not taking the opportunity to talk to, or they're not actively working with their client on their charitable activities. And there's a variety of reasons for this that we've been able to identify over the years. One further, in some instances, you'll find that the financial advisor has the perception that if they talk to their client about charitable giving and those assets go off to a charity, that the financial advisor will lose those assets. And that's a legitimate concern. but there are ways of handling that. And the donor advised fund can be very effective in that. It may be that they just don't bring up the subject because they're not comfortable in talking with the subject. It's something they just haven't really been comfortable in talking about with their clients. It may be that they perhaps consider themselves in talking to their clients as invading their clients' privacy, when in fact, really, they're talking to their clients' financial assets. This is just their charitable assets. And also you'd find that maybe the advisor has never personally been involved in charitable giving themselves. So the whole issue of charitable giving, they might be a little bit uncomfortable with.
Very true, very true. And then moving on to kind of the meat of our subject matter today, that concept of the S-corp shares and C-corp shares. I'll kind of turn the podium over to Brian to kind of speak about some of the differences and similarities and engage into some of the specific strategies. Brian, podium is yours.
Well, thank you, Eric. I don't know if I guess it's the headphone is mine, so in terms of the format here. Well, I want to take just a minute or two to weave some of the concepts that Phil talked about specifically with donor-advised funds sort of into the illiquid topic of the day. And that is first, I hate to say this, but I will anyway, a somewhat smart sort of chipmunk could have done charitable planning from 1982 to March of 2000. And charitable planning over nearly 20 years was simply looking at that asset that was publicly traded stock, most always, that it appreciated the most. And for all the flexible benefits that Phil alluded to, those were really sort of tailor-made for charitable giving during that time, given the longest, biggest bull market in the history of the world, which was glorious on lots of levels. After that point, however, I think we all, and certainly your clients, I would suggest, all have a very different definition of what liquidity is today versus perhaps 2006 or 2007, which are causing people and planners to be much more thoughtful and intentional about the kinds of assets that they're using, sort of beyond cash. Cash is the worst way to ever make a charitable gift, most always. Let's start there. It is typically the smallest piece of the overall balance sheet for most all investors. It is the least tax effective, and it hurts their lifestyle the most. So none of those things are good. Instead, using this glorious donor-advised fund vehicle, being able to look at assets that are not as liquid as certainly cash or marketable securities, but in this case we're defining illiquid assets as anything that's not liquid. So real estate would be a very, very large portion of the work that we do, and I know AEF does as well. And then certainly the next biggest chunk are privately held interests. So when you then look across the balance sheet and you have the person that has real estate with a very, very low cost basis, high appreciation, perhaps no debt is ideal, it almost works exactly the same way if it's Boeing stock or Microsoft stock or Coke stock, in that, as Phil mentioned, going into a donor-advised fund, the donor is able to get a full fair market value deduction for that gift, just like publicly traded stock. It can be sold without any capital gains tax, and as he mentioned, can then grow tax-free going forward to create that sort of charitable bucket that family can use for one or multiple generations. Within privately held businesses specifically, what we see the most of are S-corp and C-corp shares. So when you look at S-corps specifically, I was shocked to learn this 6 or 7 years ago, there are more S-corporations than C-corps and LLCs combined. And when you think, too, about the most charitably inclined people in this country, so your clients, obviously, it's not doctors or anybody that can spell healthcare, so you probably already knew that. But in every community, every single community, the most charitably inclined people are real estate wealth and closely held business wealth. Always. What do real estate wealth developers have in their asset mix? Real estate. What do privately held business owners have in their asset mix? Obviously, it's privately held business interests, which most always are going to be S-corporation stock. So when you look at the bulk of their net worth being in these privately held businesses, and then you also think, too, about the cost basis or their original cost to create that business is usually quite low, my joke is that most every S-corp and C-corp share in this entire country has a tax basis of 32 cents a share. It's always 32 cents with a lot of appreciation. So when you're thinking about from a tax planning perspective on how to do that in the most optimal way possible, the holy grail you see there is contributing long-term capital gain property with the lowest cost or tax basis, which in many cases can be real estate, kind of a subject for another webinar, where that's been depreciated down over time, or these closely held business interests that start with an incredibly low cost or tax basis. So they can be perfectly suited for donor-advised funds because it can be one transaction to the donor-advised fund, the one qualified appraiser doing the one qualified appraisal, and then post-sale, the donor can then make grants to the 1 to 10 public charities that he or she perhaps would like to have given it to before that transaction, so it can be bifurcated post-sale within that donor-advised fund, and or continuing to be managed by their investment advisor to be able to grow over time to make a larger gift or grant into the future. So that's a quick sort of broader summary from the very sort of macro to the more micro. So now let's go through an example of S-corporation stock itself and kind of how this business sale works. Now, I first want to say that we're going through a flow chart of S-corp. We'll do the same thing for C-corp, very, very similar. But I want to make a couple key points here. So the first point there is you see the donor. And the donor in this case is making a donation of 10% of that S-corporation to a donor-advised fund that is in trust form. So a public charity that sponsors a donor-advised fund, but that public charity's entity, still a 501c3 public charity, but is simply in trust form versus corporate form. And we'll make clear on the next slide why that's so important, and specifically for S-corporation stock. But the first thing I want to mention, and this is so important, the donor here is only giving away 10% of the business. Could it have been 1%? Could it have been 49%, 51%, 100%? Yes to all of those things. But at least in our practice, I think we've done perhaps 500 or so of these transactions. About 3/4 of these are fractional interest gifts. And the point is the donor does not have to give the entire business to enjoy all the benefits that we're going to describe. So in this case, the donor is giving a 10% interest over to the public charity. Then you have a buyer. Now, does that buyer care if the buyer is buying 100% from the donor directly, or 25% each from 4 different trusts, or one of the current shareholders being the donor-advised fund? The buyer doesn't care. You agree to terms. The donor-advised fund that can then sell its 10% interest as the donor sells his 90% interest. For the 10% interest, which we'll go through on the next chart in a moment, the donor will get a full fair market value deduction for that and can, in many cases, help wash out much of the capital gain that the donor will recognize from the sale of the shares that he is holding back. And then it's a fairly straightforward process after that. Once the donor-advised fund sells that 10%, then if it's in our case, then we've worked for many, many years with American Endowment Foundation. We simply make a grant of the net proceeds right over to their fund at the American Endowment Foundation so that they're creating a new donor-advised fund there, or simply adding an existing, adding more proceeds to an existing fund. And then, as you know, as Phil mentioned, how the advisor is still involved making investment recommendations as the donor, too, is making grant recommendations. So that's at least the flow chart. So let's take a moment, too, to go through the specifics of the math behind it. This will be pretty general in nature, but if we can advance to the, yep, there we go. And by the way, too, as Eric mentioned, we'll be able to have, I think, a fair amount of time for questions at the end. So as you're going through this, if there's specific questions, I'm more than happy to answer these at the end. So in this case, let's maybe focus on the left side of the column here, the straight gift to a donor-advised fund. So if this is given to a most traditional donor-advised funds, this would be a charity in corporate form. And by the way, any other charity in corporate form, so if it's the Boys and Girls Clubs, if it's Red Cross, if it's any other public charity that's in corporate form, this is exactly how, generally speaking, the flow from a tax perspective works. So the donor can make the contribution. In this case, we're assuming $1 million of S-corporation stock. The charity can sell that stock for $1 million. The donor can get a fair market value deduction for those shares. A couple minor exceptions there, but we're going to gloss through that. But as long as a qualified appraiser completes a qualified appraisal, said that those shares were worth $1 million and all of that would have been long-term capital gain at the time of sale, the donor is able to take $1 million fair market value deduction. Again, just like Microsoft stock. Still subject to the 30% of adjusted gross income limitation, so all of that is the same. When the charity sells the stock, here's where strange things happen with S-corporations. Prior, by the way, to 1998, charities couldn't even own S-corporation stock. It would immediately blow the S election. At that point, a law was passed to allow charities to own S-corporation stock, but to basically pay for the benefits that they were then giving up through the additional deductions. What they said is, but the charity has to take a carryover basis from the donor. And then when the charity sells that stock, the charity must recognize unrelated business taxable income, UBIT, on all of that gain. So that's called all pre-contribution gain, the original cost to the donor all the way up to the sales, to the value as of the date of the gift. Plus, if there's any income during the holding period to the charity, that is all unrelated business taxable income. Plus, if there is any additional appreciation, so maybe the donor's deduction is $1 million, but the charity sells it 8 months later for $1.1 million. That additional appreciation is also unrelated business taxable income. So what does that mean in the corporate sense? So if this is given to a charity that sponsors a donor-advised fund or not, doesn't really matter. The donor can get this $1 million deduction. In this case, you see my asterisk here saying that we're assuming a zero cost basis to keep the math simple, that corporations, as you all know, do not distinguish between capital gain income and ordinary income. So in this case, this would all be at corporate rates. I'm assuming 35%, could be a little higher or lower. Could also have, obviously, a state income tax on top of that, so very often it's closer to the 40%. But in this case, the donor makes the gift for the $1 million, is able to get the $1 million deduction. Let's assume the charity sells it a month later for $1 million. In this case, the charity would have to write a check for $350,000, 35% of the $1 million gain. So the charity writes that $350,000 check, and then the donor-advised fund, assuming that's the case here that's in corporate form, would receive $650,000. Now, some might be saying, yeah, but that's happening after the fact. At least my client is still getting the $1 million. Your clients don't like that so much. They want to get the $1 million deduction. But many advisors, based on this math, would say, you know what, don't make that S-corporation gift to charity. You sell it yourself. And if you sell it yourself, you're at the personal long-term gain rate at 20. Maybe you have a state income tax around 5-ish, so that's 25. And also you may have the 3.8% tax perhaps on the net investment income. Still, you're at that 25 to 29% or so. That's better than 35. But here's a solution. So when you go to the next column, what if all of that structure were similar, but the charity was in trust form, not corporate form charity, trust form charity, and it also sponsored a donor-advised fund? There are a number of these out there. We have one, but in this case, let's go through how that may differ. This is very simply the difference between an entity taxed as a corporation and an entity taxed as a trust. That's the only difference here, but you'll see how profound it can be. still gets the same $1 million deduction. Charity still sells it a month later for $1 million. But a taxable trust is taxed as an individual for income tax purposes for capital gain and for charitable income tax deductions. What does that mean? That means if the charity sells it a month later and it is in trust form, it has to recognize $1 million of gain. But it's able to recognize that gain at personal, individual long-term capital gains rates, which is federal 20%. Our charity is in Nevada. My joke is all good things seem to happen in Nevada. So there's no state income tax there. So now we're at the 20% rate. It gets better. Because our donor-advised fund has a standing grant recommendation, if that is the donor's wish, for it to be granted right over to the American Endowment Foundation donor-advised fund, then we, as the taxable trust in this case, are able to get, like an individual, a 50% charitable income tax deduction at the trust's level. So that takes the $200,000 tax down to a $100,000 tax. We can't get rid of all of the tax, but because this is in trust form, because there is no state income tax, and because we're able to get a 50% deduction at the taxable trust level for a cash contribution to another public charity. When all the dust settles, the donor gets the $1 million deduction, and the net gift over to the American Endowment Foundation's advised fund is $900,000. Now, to be fair, most charities do charge a 2 to 3% fee. That's what ours does for this too. So it might be slightly less than this, 2% less. Not that big of a deal, because in this case on the bottom we should have giant blinking lights that are flashing. Simply by being smarter and more tax optimal in terms of the entity structure on how the S corporation is given, rather than taking into the left pocket that is in corporate form, we are recommending that they might take it into the right pocket in trust form, and simply by doing it through that structure, the charity that is available to be granted into the donor-advised fund increased by $250,000, which is also part of, obviously, the overall investment bucket and working with their advisor to make that $250,000 grow that much faster. So that's incrementally $250,000 better by taking it through the right pocket than the left pocket. So that's how that structure works. How about we go through a C-corp, and I will tell you now, C-corp is a lot easier, so if your brains are hurting now, we thought it best to lead with that one and then be easier as we can go through. So that's the bulk of the complexity. The real key point before we jump into C-corp, S-corps on the table. There are more S-corps than C-corps and LLCs combined, as I mentioned before. And for those individuals who are charitably inclined, I will almost guarantee you they have never thought it was possible to give some or all of their S corporation to pre-fund their current, future, and perhaps next generation's charitable interests by using the lowest cost basis, highest appreciation assets that they have, which in this case could be their S corporation. Everything that I just said applies to C-corps too. You will see here a flowchart that is not so strangely similar, nearly identical to what we talked about with an S-corp. The difference with a C-corp is, and this is glorious, all of that unrelated business taxable income goes away. So if it's a C corporation, if it's real estate without any debt at all, LLC interest, LP interest, so long as there's not sort of an active business or underlying debt, all the UBIT goes away. The only time unrelated business taxable income comes up, the majority of the time I should say, would be S corporation stock, active businesses like LLCs and LPs that are flow-through entities but active businesses, or anything with debt-financed income like real estate or other flow-through partnerships. For C-corp, all that's blocked anyway. So for C-corp, in this case, you've got the donor giving the 10% interest over to the donor-advised fund directly to the American Endowment Foundation, so they can receive that directly. The great part about this is a very key point for S-corp, for C-corp, and all other privately held businesses. there are multiple liquidity options. In this case, we have an ESOP. That comes up a lot for us, probably a quarter to a third of the time. It's either the S-corp or the C-corp being sold to the ESOP. Could instead, rather than it going to the ESOP, could it go to an existing shareholder? Could it go to an outside trust? Could it be part of a merger or acquisition? Could it be for a new shareholder? Could it be prior to an IPO? Yes to all. If there is any liquidity event or exit strategy where there's going to be a sale and there will be a recognition of that built-in gain, a built-up gain with very low cost basis, high appreciation, ideally, that's where you as the advisor would be raising the question to say, if you've ever thought about being charitable, if your kids will be charitable, if your grandkids will be charitable, kind of now's the time. We can take a piece of that business, transfer that over to AEF, take that full fair market value deduction, no capital gains tax at the time of sale, all out of the estate for estate tax purposes. It's then part of our overall asset under management program and is all growing tax-free. I mean, that's just fantastic. One key point, this goes beyond a bit of the scope of this webinar, for any of the assets that are liquid that we mentioned, there cannot be a prearranged, legally binding agreement. If there's a legally binding purchase and sale contract with lots of signatures and lots of dates, that's just bad. So this really compels the financial advisor to have that discussion as early in the process as possible prior to there being this legally binding contract. So that's really explains the C-corp. And again, could I take out a C-corp from this slide and put an LLC? Yes. Could I take out ESOP and put in a current shareholder? Yes. So it's very sort of a number of permutations as it relates to the overall concept, but the theme here, low cost basis, high appreciation, long-term gain property, can fit just perfectly within a donor advised fund construct. So let's go through the next slide. This will be quite quick as we go through the analysis with C-corp. Immediately what you'll see is all of the UBIT goes away. What we thought instead, though, rather than having the UBIT discussion, what we hear all the time is, well, what happens if we just have the donor, our client, sell the stock and then make the donation? That just seems so much easier to do. Or what if it is getting ready to be a prearranged sale? Well, how bad would that be if that were legally binding at the time the gift was made? It creates an assignment of income issue, by the way, so all the capital gain that your client thought he or she was getting out of will all come back on them. That's not good on any level. So you see here on the left side, we're assuming the same zero basis. We assume that's sold. We assume, too, the 25% federal and state could be higher or lower. And then I did include, too, the 3.8% sort of surcharge. It may or may not apply, certainly to a client. The real key takeaway that I want you to think about is that never applies on the charitable side. So that 3.8% goes away within either the trust form charity or the corporate form charity, does not matter. 3.8% doesn't sound like that much until your clients actually see how much that is. They're particularly annoyed by that given the newness of it, as you well know. And also, it's very important, it becomes certainly much more material in that the average gift our group has worked on since 2003 has been $2.35 million. So at 2.3 million plus, 3.8% becomes material pretty fast. So the key point here is that may apply on the donor side. It does not ever apply on the charitable side. So assuming, obviously, lots of various assumptions here, those taxes are pulled out, then the net proceeds that could be donated over to the charity would be $712,000. So this assumes a C-corp sale, or could this be a real estate sale? Yes. LLC? Yes. LP? Yes. All the same. If they're selling that, there's zero basis. If they've got long-term federal state tax plus that 3.8% surcharge, that plug number will be de facto the same in every situation. Instead, you could say, Phil, I'd like to explore opening a donor-advised fund there at AEF, And before there's this prearranged sale, how about we make the gift over to you directly? We'll have a qualified appraiser doing the qualified appraisal, $1 million deduction. I'm right back to my Microsoft stock again, same thing. Then AEF can sell that to various parties that I mentioned. Let's assume that AEF sells it a month later for $1 million. The tax on the sale to the donor or to the donor-advised fund is 0. 0 is a good number from a tax perspective. And now what are the net proceeds in the DAF? The full $1 million. So in this case, it's nearly a 30% pickup based on the assumptions by making the gift first rather than either selling the gift or having it under contract first, which would de facto be the same as a sale anyway. So for all of the reasons you would say, don't ever sell that Coca-Cola stock that you bought for $5 a share that's now $50 a share. That would be bad to do. Instead, you should give that over to the charity if you wish that to fund your charitable giving. Create the donor-advised fund to do that. The real key takeaway is it is exactly the same thing for closely held business interests and for real estate. So same theme, same concept, same benefits. So let's go on to the next slide, and I think we pass it over here.
Correct. This is, we'll turn the podium over to Phil, but I'd like to say just a quick thank you to you, Brian. You really underscored the variety of ways that our different audience members out there can put illiquid assets such as S-corp and C-corp shares into a way that is really quite innovative.
I think one of the significant things that comes out of this thing is and I've been noticing it since I really got involved in donor advised funds back in the early 80s, is that the enormous transfer of wealth that is going from my generation, and Stanley, I'm 82, from my generation down to my heirs, and then from them down to their heirs. There's this multiple generational transfer of wealth, and it started out originally, one of the earlier estimates was $10 trillion, $6 to $10 trillion, but more recently it has been revised that on the conservative side it's closer to $43 trillion, and on the more optimistic side, $146 trillion. So it's an enormous amount of money that's being transferred over. Much of that wealth in this country is not in marketable securities, but rather, as Brian said, in closely held shares and in real estate and in life insurance policies for that matter. But in any case, these assets are going to transfer. And if you're involved in those, fine, you can help. If you're not involved in it, if you're not talking to your client about it, the clients are going to be missing some wonderful opportunities to efficiently transfer those assets over. And yet on the side of the financial advisor, what does that need for him? Well, and I see it time after again, when we go through a gift of an illiquid asset, the financial advisor is, after all the dust is settled, is managing more of their clients' assets than they were before, because before they were locked up in the business. I mean, I can even write one example where the client basically gave $10 million in real estate to us. The client died shortly after that, but before he did it, he converted that donor advised funds, which would originally had real estate in it, that was sold, and it resulted in a $10 million deduction and a $10 million foundation. The donor converted those assets before he died to the point where the financial advisor is managing those assets as an endowment to support 2 different colleges. So not only is the financial advisor managing more of the client's wealth, but he's managing it forever. And so when you think about how a financial advisor values his business, any kind of a stream of income that's coming in on a continuing basis year after year after year has a tremendous effect in determining the value of that business. It also is a wonderful way for the client to offer really meaningful solutions to their client in ways where their competitors are not discussing those types of subjects. So the opportunity to discuss charitable giving, it's an enormously attractive thing for the client. It's an enormously attractive thing for the financial advisor. And I'll stop at that.
Very good. Thank you so much, Phil. I'll turn now to a few of the questions that we have from our audience. One question I will address immediately. I know a few people have asked if a PowerPoint of this presentation will be available, and the answer to that is yes. An email will go out tomorrow that will have a link to a copy of this PowerPoint presentation, as well as a link to a recorded version of this webinar. One of the first questions I'll turn to, and I'll probably have Brian answer this. I think you probably touched upon in this in your presentation, Brian, but the question that is posed is, once a merger is announced and an agreed share value is published, is it too late for the acquired company to donate shares?
Thanks for leading with the most difficult question possible. That's always nice.
Sorry, Brian.
It's a good question. It's a good question. So who knows is the answer, and it depends. You know, the great thing about financial planning is you just say it depends all the time, because that's usually the case. There are 3 cases that sort of go to this that I hope actually you won't look up. Palmer case, Blake case, and Ferguson case. The general rule is that if the deal is more than 50.1% baked, it is then too late. So if you've got, let's say, a tender offer, and 48% of the shares have been tendered, so it's not completely done yet, you're at 48%. Could you still do it? Most people would say yes, and there's some case law that really goes to that. But when you've got certainly details in the paper and closing dates, and again, sometimes if there are, again, lots of signatures and lots of dates, that's not usually a good narrative on any level, unless it says non-binding on, for example, a letter of intent. If it says non-binding on every page and the buyer or seller could walk without general recourse, then you're generally okay. But when we talk about this 50.1%, you know, what does that even mean? How can you get your kind of brain around that? If you're thinking about real estate as an example, is that the LOI? Is that the time it actually goes under contract? Is that when certain contingencies are removed? What if one contingency is much greater, like a zoning contingency that has a very lower probability of occurring? You could just get your brain all sort of wrapped up in a knot on that. So what I would do, I guess, is sort of punt Eric in 2 ways. One, earlier is better. Let's start there. So let's not wait until the last possible moment. Let's take a couple good steps back. And the second thing is, all of this becomes a facts and circumstances sort of test, and to make sure that there's sort of good legal counsel if it starts to get more and more gray, or starts to go from gray to black in our scenario. So all things being equal, if you got lots of details out there, lots of dates, lots of signatures, that's usually too late. And I will say about 1/3 of all the calls that I get, it's too late. 1/3 of all the calls I get from the advisors would say, hey, I understand this is a great gift. This will be so easy for you. It's going to be so easy, nonprofit. All you have to do is show up next Wednesday and just collect your check. I'm like, shut up, because that means it's completely baked, completely done. They've already got the closing scheduled, and they had the thing under contract 2 months ago. So that's the problem.
I think the secret here is not necessarily relying on folks like Brian and I and me, but rather looking to the donor's financial advisors, primarily his legal counsel and his tax counsel, as to how far this deal is along. And they're going to have to answer that question when the client says, is it far enough along that I can do it, or is it too late? They're going to have to answer that question. And again, as Brian said, it's facts and circumstances.
Very good, very good. Another question we have, and this one I think I'll probably pose to you, Phil, is the question is, can illiquid assets, let me read this again. Can illiquid assets be placed in any donor-advised fund?
Yes, they can. Not only can they be used, subject to all the due diligence that has to be done on that, they can be put into a donor-advised fund. Recognize, as Brian said, there is a potential liability for unrelated business income tax when we sell those assets, or when Brian sells those assets. But also, while we're holding those assets, there is an ongoing unrelated business income tax liability for any of the earnings that go on. Am I correct on that, Brian?
Yes, that's definitely correct.
So it's something you want to look at. Yes, we can not only receive them, we can hold them, and then there are some little strange rules that come out of the woodwork that relate to the percentage ownership that donor has in that entity that he's contributing his assets, from to us, that may dictate that we can only hold them for 5 years. No reason that we can't hold them, but if he has a certain percentage ownership that exceeds a certain threshold, we can only hold them for 5 years. So there has to be something written into an agreement that we have the option of getting out of it within 5 years for no other reason other than just avoid a very, very onerous excise tax that the IRS imposes on it. It's not a problem. It's just usually something you have to recognize. But yes, we can receive them and we can hold them.
Now, related to that question, I know obviously you're speaking from the perspective of American Endowment Foundation. In your experience, is it, are other donor advised funds as innovative or as flexible in this particular circumstance?
Well, this is available to a lot of different donor advised fund programs. I think the motivation I'd have to ask is, do they really like these things? Some of them do. Some of them do, and they're good at it. Some of them are good at it, but they don't really talk about it too much. So what I find very intriguing is when financial advisors come to us and we start asking some questions. Does your client have any illiquid shares? Can you give you an example of what they might have? All of a sudden you find out that this is the first time they've ever really thought about their clients gifting of illiquid assets like closely held shares. And that's when it really gets fun. Because as you peel that onion back a little bit, you find out, yeah, he has something. He never really thought about giving anything like that away. So I can't say that my competitors are not doing it. I just know that there's a lot of financial advisors out there are very, very surprised and very, very welcoming on the fact that, yes, it can be done.
Excellent. Good to know. Another question I have, and I'll pose this to either of you gentlemen, because I think either one of you can answer it. The question is there any dollar limit or percentage limit that restricts how much value from closely held shares can be placed into a donor-advised fund? So is there any sort of regulatory guidance that restricts of, what the total dollars that could be placed from such some of the deals that Brian has shown?
There isn't a requirement relative to whether it's liquid or illiquid assets. There may be an issue for some charities because some charities like American Endowment Foundation, we have to meet the public support test. But that it would only be unusual that such a large amount was given to us that would adversely affect that public support test. But we're nowhere near that. Won't be near that for years and years and years into the future. So the answer is no, there's no limit imposed just because of the fact that it's closely held shares.
Okay, good to know. Here's another question, and this one, perhaps might be more in line with maybe Brian, but the question is, what if you have an LLC taxed as an S-corp? Is it treated as an S-corp where they have to worry about UBIT, or is it treated as an LLC where they don't have to worry about UBIT? Brian, if you thought that first question was hard, I think this one is probably an equal match.
I was going to say, is this like stump the speaker time of the webinar session here? Well, if it's deemed to be an S-corp, and you got LLCs that are taxed as partnerships or corporations, so I guess if this is a sort of deemed S-corporation, I don't think I've ever dealt with this, and I do a lot with S-corp. So I'm thinking if it is packaged as an S-corp, I would assume or presume that actually then would trigger the same UBIT sort of implications. You definitely would have any of the attributable income coming out on the K-1 during that holding period will all be UBIT. So that's going to be whether it's an LLC or an S-corp, assuming an active business here and not sort of passive assets or investments within that. So the real question then is, with the existing or initial basis, then also roll over to the charity, we would have to pay tax on all that pre-contribution gain. I'm pretty sure that it would, but that's a higher end question I have to dig into a little.
Brian, I've had to answer that question, and based on the legal counsel or the advice of our counsel is yes, if it's treated as an S-corp, regardless of how it's organized, then it follows the S-corp rules with regard to UBIT.
And that's what I would guess. We always know that the IRS kind of takes if it's better for them, that's how they're going to categorize it. So in that case, I think that it probably would. Eric, if I could jump back for 2 seconds, though, and Phil did a great job answering kind of the question of the gigantic gift. He also mentioned the whole issue around excess business holdings,
yes,
which would say if you have too much of the business, and that actually has attribution rules, so it pulls in all beneficial trusts and related parties and all these other kind of people. it's a very wide net, by the way, that you do have this 5-year disposition or a tax anvil, and I mean it is an anvil, will hit the charity that Phil alluded to. It's a crazy big number. I guess in a weird way, I might flip it the other side, and that isn't the question that's being asked, but rather than it being, is there something that's too large, I get the question a lot about, is there something that's too small? Mm-hmm. And generally speaking, we'd normally want to see, especially S-corps, around that $200,000 level and kind of above. We've gone down to 150 before. Again, our average is just under 2.4 million. But C-corp, a little bit more straightforward, no UBIT. I'll kind of defer to Phil on what they look at there. We're usually around the 150 or more on C-corp, because when we're talking about getting a qualified appraiser and a qualified appraisal, that sounds like, hey, that's no big deal. It can be a bigger deal. So if you're doing a $100,000 contribution and it might cost $8, $10, sometimes $15,000 to just get the appraisal done, in many cases it starts to dilute the actual overall benefit once you get down to a number that's too small. Each one's different based on the circumstances, but just something to keep in mind. If you're going to do an S-corp for $30,000, that's not going to generally work. Just have the client sell it, make the cash, or even better, other appreciated stock over to their AAF donor.
Sure. We do it on again, the facts of the particular case, what the donor is trying to accomplish. Our limits, we can be a little bit more tolerable with regard to non-S-corps, like C-corps or LLCs. It's just listening to what the donor wants to accomplish, and if it's part of an overall strategy that includes other types of assets that are going to be contributed, we can go down to pretty reasonable levels. We also understand that the donor, in entering into any kind of an agreement of an illiquid asset, is that there is a memorandum of understanding that they must pay certain costs associated with acquiring that asset if we have to incur those assets, any kind of legal expenses, or let's say if it's the sale of a residence or a piece of real estate, if there's any sales commissions on that. So there has to be certain understanding by the donor. If you're going to do that for a relatively small piece of asset, you're liable to find some of those acquisition costs, due diligence costs, might be pretty extensive relative to the small sale of the asset. So yeah, you have to be reasonable about it. You have to be reasonable about it.
Here's another question that we have in the time available. Seems like a straightforward question. I'll refer this one to Phil. Can funds from a donor-advised fund be used for anything?
No. Yes and no. Again, it depends upon. This is I learned this from Brian's. It all depends. They can only be used for charitable purposes, but within that, there are some rules that have been applied and let's say codified since 2006, where the donor advised fund was first defined in the code, even though they were created in the 80s, 1980 or so. They were just codified by the IRS and recognized as an entity of charitable giving in 2006. And those rules said that you can only use these assets for charitable purposes. You can't, for instance, make a grant to an individual. We can't use those grants for political purposes. We can't contribute to the Michigan Republican Party. We can't use those grants where there would be a personal benefit. There are half a dozen of those rules. They're relatively small. And very often the donor may not understand it. Like, for instance, they can't make a grant to satisfy a personal pledge, and yet pledges are used in the charitable world and have done so for years. It's a matter of sitting down with the donor and talking to them. Very often they don't realize they're getting into some water there. So it's not a matter of saying, no, you can't do that. It's a matter of saying, we might have some problems with that. Let's see if we can find another way to do it. If, for instance, the donor wants to make a grant to a Little League in Kansas City, and a Little League in Kansas City is not a public charity, it's not a matter of saying, no, you can't do that. Let's see if we can find a charity in Kansas City that can act as our agent, which we can make the grant to, and then they can distribute that money to. So it's really trying to not go around the IRS rules, but try and do it in a way where it makes sense for the IRS.
Okay. Very good. Another question I have, this one just came in, I find it very interesting. If a gift of LLC interest is made to a donor-advised fund, and then the business does not sell as expected, can a donor buy back these shares from the donor-advised fund?
Brian, you want to try that one? I haven't answered, but go ahead, try that one, Brian.
I was going to say, I just love this, Phil. Every time an easier one comes up, relatively speaking, it's pitched to you. So we'll have to The next webinar, we're going to swap that around. The quick answer is yes. So as Phil alluded to, the 2006 Pension Protection Act that finally defined donor-advised funds also tightened any kind of prohibited transactions, right. And created, in essence, a bit of a safe harbor around any kind of transactions with a disqualified person. So all that means is it can generally be done, but it is a best practice and really required for the charity to get an independent outside appraisal, right, that would deem that value to be $347,000. And then, I don't know why I keep talking about chipmunks today. I guess I have them on the mind for some reason. But if a chipmunk came in and wanted to buy it for $347,000, or the donor or somebody else in the open market, the charity can sell it back to that donor or other related party disqualified person, so long as that independent objective appraisal was within a reasonable time period of that purchase, right, so that if the IRS came in and said, wait a minute, you just sold that to a donor for less than fair market value, which is bad, 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 they can say, no, we didn't. We got this independent appraisal. He said $347,000, and we sold it back to that donor for $347,000.
Now, I have a particular instance where that happened. The money went to the kids. The property was sold to the kids. The real estate was sold to the kids. They had their appraisal, fair market appraisal. I called for my own. So basically, I had a totally independent appraisal. And then I used the difference between the two of those as sort of a reasonableness test. And the donor ended up suggesting that we sell it to the kids at the higher appraisal. He really said, I want these kids to pay full, the highest amount they could. So he basically steered it towards the higher one. But I had in my pocket, in my own independent appraisal, that I could defend that we sold it for higher than what my appraisal was. I would never sell it to them for less than my appraisal. I don't care what the donor comes up with. I wouldn't sell it for less than my appraisal. But if somebody wants to come along, including a chipmunk, and pay more than that, that's fine. I don't know any chipmunks that are in the business right now, Brian. You should be focusing your attention on financial advisors, not chipmunks.
Maybe so, maybe so.
Very good. Well, gentlemen, that brings us to the almost the end of our time period today. For our audience members, if we did not get to your question, we will reach out to you individually to try to get your question answered for you. On the screen, you see, of course, the contact information for Phil and Brian. Gentlemen, thank you for giving us your time today to share with our audience members. As I mentioned earlier, a copy of this presentation will be forwarded out to our attendees via email tomorrow. But again, we thank our audience for giving us a portion of your day to learn a little bit more about this topic. And that concludes our presentation today. Thank you, everyone.
Thank you, everybody. Bye-bye now.